Hello and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's go watch the analysis.
$139.74. That's the close. As of today, February 17th, 2026. But look, if you just look at the raw price, you miss the absolute violence of the move we're seeing. We are looking at a beta of 3.12. For anyone who doesn't watch the Greeks every single day, that means Bloom Energy is currently trading with more than 3 times the volatility of the S&P 500. And if you zoom out just 12 months, well, we've witnessed a massive appreciation of 497%. We went from a low of $15.15, which, let's be honest, was effectively penny stock territory for a company this size, to a recent high of over $176. This isn't just a stock chart going up and to the right. This is a fundamental re-rating of what this company is and what it represents to the global economy.
I mean, Bloom Energy has successfully decoupled itself from the struggling, sort of idealistic green energy sector and firmly attached itself to the AI infrastructure sector. It's not a fuel cell concept anymore. It's the picks and shovels of the AI power crisis. ORIS. And it's the definition of technical exhaustion and extreme speculation. I'm looking at the exact same chart, but what I see is a relative strength index, the RSI, that hit 72.11 in late January. That is textbook overbought territory. I mean, when you have an RSI that high, it means the buying pressure has been so intense, so one-sided, that the stock is statistically screaming for a correction. You mentioned the volume peaking at 20.9 million shares on the February 5th earnings call. To me, that doesn't signal stability or institutional conviction. That signals a frantic momentum trade where everyone is piling in, priced for absolute perfection. The market is currently ignoring significant regulatory hurdles and operational execution risks in favor of pure hype. We are seeing a pullback for a reason, and I think what we're seeing today is just the start of a reversion to the mean.
The pullback is consolidation. It's a necessary breather after a historic run, right? You can't triple in value without shaking out some weak hands or profit takers. But let's look at why that run happened. My position is simple, and it's based on physics, not hype. The grid is broken. It is antiquated, it's slow, and it is congested. Meanwhile, artificial intelligence, specifically the training of these massive large language models, needs gigawatts of power, and it needs them now, not in 5 years when the utility company finally upgrades a substation. We are facing what I'd call a power expectation gap of 1.5 to 2 years.
Can you just clarify exactly what you mean by that gap for our listeners? Because gap can mean a lot of things in this industry.
Sure. It's a timing mismatch. It means hyperscalers, the Amazons, Googles, and Microsofts of the world, can build a data center shell and fill it with servers significantly faster than a utility can physically connect that building to the high-voltage grid. You can pour concrete and rack servers in 18 months. Getting a new high-voltage transmission line permitted and built, that takes 48 to 60 months. So this has forced the market into a bring-your-own-power or BYOP reality. Bloom isn't just an option. For many of these sites, it is the only scalable solution available that can be deployed in 90 days to a year. And the financials prove it. Q4 2025 revenue hit $777.7 million, beating estimates by 20%. Non-GAAP EPS came in at 45 cents, completely crushing the 25-cent estimate. This is a company that has found its moment.
I don't dispute the revenue beat. The numbers on the page are the numbers on the page. They had a great quarter, but I dispute the sustainability of the valuation that's attached to it. My thesis is that the company is priced as if it has already solved the scaling problem, but the risks are actually mounting. You have a company trading at these elevated multiples, yet when you look at insider activity, what do you see? Net selling. CEO K.R. Sridhar sold approximately $14.8 million worth of stock. I see no major discretionary buying at these $140 plus levels.
Oh, come on. Executives sell stock for tax planning and diversification all the time. You can't read a lack of faith into a standard liquidity event after a 500% run-up.
But usually not when they believe their company is about to become the most important infrastructure player in the world. That sale tells me management knows the valuation is rich and they are taking chips off the table. Furthermore, they are attempting to double manufacturing capacity in a single year. Do you know what happens when a complex hardware company tries to double output in 12 months? Supply chains break, quality control slips. It is a logistical nightmare. And we haven't even touched on the One Big Beautiful Bill Act, or OBBBA, which has tightened tax credit timelines and introduced strict domestic content rules that Bloom may struggle to meet. At $139, the risk-reward ratio is unfavorable compared to support levels down at, say, 122 or even 131.
I think you're reading too much into the insider selling and missing the forest for the trees. Let's get into the core of the debate, specifically the technology itself. You mentioned the valuation is rich, but I would argue the market is finally pricing in the moat. Bloom has a specific technological advantage that the market is just waking up to: the 800-volt DC architecture.
Is that a moat or is it just a feature? Because moat implies it's undefendable by competitors.
It's a moat when you understand the physics of AI computing. We need to simplify this for a second so everyone grasps the magnitude. AI server racks, the actual computers doing the thinking, run on direct current, or DC. That is just how computer chips work. However, the traditional electrical grid, it delivers alternating current, AC. So to get power from the grid to the GPU, you have to convert AC to DC. Every time you do that conversion, you lose energy. And where does that energy go? It turns into heat.
Which is exactly what data centers hate. They spend a fortune getting rid of heat.
Exactly. Heat is the enemy. You have to spend more energy just to cool down the heat you generated from converting the electricity. It's a vicious cycle. Bloom generators are unique because they generate DC natively. They don't need those wasteful conversion steps. They connect directly to the bus bar of the server rack. This improves PUE, power usage effectiveness. That number is the holy grail for data center operators. If you lower your PUE, you save millions in OpEx. If you compare this to something like Plug Power, the difference is stark.
Well, Plug is a different beast entirely, isn't it?
It is, but they are often bucketed together in the same ETFs, so people conflate them. Plug uses PEM, proton exchange membrane technology. That works great if you need to power a forklift that starts and stops all day. It's terrible for a stationary, high-heat data center that needs to run 24/7. Bloom uses solid oxide fuel cells, or SOFCs. They operate at very high temperatures, which makes them incredibly efficient for continuous power. That's why Bloom's return on invested capital, their ROIC, is positive 4.62%, while Plug Power is sitting at a negative 57.91%. One is a business, the other is a science project.
Okay, I will grant you that Bloom is a superior business to Plug Power. The metrics clearly show that. Plug is struggling with a negative ROIC and a model suited for mobility, not density. But let's be honest about what Bloom's moat relies on. It runs on natural gas. They say it is hydrogen-ready, and that's a nice marketing term to keep the ESG investors happy. But today, right now in 2026, it is dependent on natural gas prices. You are banking on a permanent advantage in a commodity-based input market.
Gas is abundant in the U.S. It's the transition fuel. We have more of it than we know what to do with.
Abundant, yes. Stable? Not always. If natural gas prices spike due to a geopolitical event or a cold snap, that economic advantage you just described, the efficiency savings, erodes immediately. If the input cost doubles, the PU savings don't matter as much. You are trading grid uncertainty for commodity price uncertainty.
But gas prices have been historically low relative to the cost of grid downtime. And that is the variable you aren't weighing heavily enough. What is the cost to Amazon or OpenAI if their training cluster goes offline for 4 hours? It's in the millions. They will pay a premium for gas to ensure reliability.
For now. But is this a permanent solution or a bridge? That's the multi-billion-dollar question. If the grid catches up, and utilities are spending billions to make sure it does Bloom remain the primary power source, or do they get relegated to backup status? And if they are just backup, does that justify a 20 times price-to-sales multiple?
I think characterizing it as just a bridge misses the strategic validation we're seeing. It's not just about the technology working, it's about who is buying it. We aren't talking about pilot programs or test runs anymore. Look at the American Electric Power deal, AEP. That is a $2.65 billion contract. Utilities themselves, the very competitors you say will catch up, are buying Bloom boxes to offload demand because they know they can't meet it.
That is a fair point. 8EP is a significant validator. They wouldn't spend that capital lightly.
And it's not just them. Look at the Brookfield Asset Management Partnership. That is $5 billion. Brookfield is blue chip money. They are infrastructure investors, arguably the smartest in the room when it comes to long-term assets. They don't buy hype, they buy cash flow. They don't put $5 billion into a bridge technology that disappears in 5 years. The backlog has jumped to roughly $20 billion. That is revenue visibility that justifies the premium.
A big backlog is a double-edged sword. It's great for the headline, but it creates a massive execution trap. Bloom aims to double its capacity in 2026 to meet this demand. Do you know how hard it is to double complex manufacturing output in 12 months without breaking something? This isn't software. You can't just copy-paste code. These are ceramic stacks that operate at 800 degrees Celsius.
They have been refining this manufacturing process for decades. Fremont is a well-oiled machine. They have the blueprint.
But never at this volume. And remember who the customer is now? These are hyperscalers. They demand 5 nines 99.9999% reliability. If that rapid scaling leads to defects in the fuel cell stacks, even a small percentage, the warranty liabilities will destroy those newly found margins. They just hit a gross margin of 30.3%. That is fantastic. I applaud them for that. But it is fragile. If they have to replace stacks because they rush production to meet that $20 billion backlog, that margin evaporates. And look at the service segment. It's finally profitable with a 20% margin, which is a great turnaround. But a manufacturing stumble sends the service arm back into the red immediately because they'll be servicing defects rather than maintaining operations.
You are assuming failure in execution, whereas the track record over the last 5 quarters shows consistent beating of expectations. They have delivered 5 consecutive quarters of earnings beats. Management has pivoted from growth at all costs to profitable growth. But I want to pivot to the regulatory environment because you mentioned the OBB as a headwind, and I see it differently. I believe the regulatory landscape actually favors domestic industrial power. Bloom is pivoting to localized supply chains to meet the OBBA requirements. The requirement is 55% domestic content for 2026 construction. Bloom is positioning itself to hit that.
Positioning and complying are two different things. The One Big Beautiful Bill Act, I still can't believe they named it that, is a net negative compared to the previous Inflation Reduction Act, and investors need to be clear about this. Look at Section 45V, the hydrogen credit. The deadline has been accelerated to January 1st, 2028. That cuts the subsidy tail that many financial models were relying on. You have less time to get the hydrogen credits than we thought a year ago.
But Bloom runs on gas now. The hydrogen credit is the cherry on top, not the whole sundae. The business model works without the hydrogen subsidy today. The arbitrage is between the cost of gas and the cost of grid power, not the subsidy.
Fair, but the valuation includes the cherry. And look at Section 48E, the investment tax credit. The new rules regarding prohibited foreign entities, or PFE, start mid-2025. This requires a rigorous, expensive audit of the entire supply chain. If Bloom sources a critical component, say a specific rare earth mineral or a ceramic precursor, from a restricted jurisdiction, they lose the credit. That is a compliance headache that slows down deployment.
Every industrial company deals with supply chain compliance. This isn't unique to Bloom.
True, but not with the stakes this high and the timelines this tight. And beyond the federal level, you have the NIMBY threat, not in my backyard. This is the sleeper risk nobody is talking about.
NIMBY has always been there for energy projects. People don't want coal plants, they don't want wind turbines, they don't want solar farms ruining the view.
It's getting worse for data centers. Look at the Hilliard, Ohio lawsuit. Residents blocked a 228-unit Amazon array. Why? Noise and emissions. A Bloom Energy server is quieter than a diesel generator, sure, but it's not silent. It has fans, it has pumps, and it's not invisible. As data centers move closer to suburbs, because that's where the fiber optics are, local opposition to gas-fed power plants is going to rise. If you have a $5 billion partnership, but you can't get the permits because the local zoning board says no, that backlog stays a backlog. It doesn't convert to revenue.
The Hilliard case is an isolated incident, not a trend. You can't extrapolate one angry town council to the whole nation. The power crunch outweighs regulatory nuance. When you have a data center that costs $10 billion to build, and that is what these AI clusters cost now, you are not going to let a zoning board stop you from powering it. You move to Texas. Texas is capturing 30% of the market, specifically because they allow fast power generation. Bloom's modularity allows them to deploy in friendly jurisdictions like Texas rapidly. The demand is so high that if Ohio says no, 5 other states say yes. The economic imperative of AI is too strong.
The economic imperative is strong, but capital is cowardly. If there is regulatory uncertainty or local friction, capital pauses, and we are seeing that friction increase, not decrease.
I disagree. I think the friction is high for the grid building transmission lines takes 10 years due to permitting. Building a Bloom box takes months. The friction is actually lower for Bloom than for the alternative, which is waiting for the utility. That's why the service backlog is $14 billion, with a 100% attach rate. Once you are in for 20 years. That is sticky revenue.
Let's talk about that service backlog for a second. You mentioned it has a 100% attach rate. That's great for recurring revenue, assuming the tech holds up. But again, it ties back to the natural gas input. If the cost of running these boxes doubles because gas prices go up, that service contract becomes an albatross for the customer. They might look for ways to exit.
And go where? Back to a grid that tells them wait 5 years? There is no alternative. That is the definition of pricing power. When you are the only water in the desert, you don't worry about the price of the cup. Bloom is the water.
There is always an alternative. Batteries are getting cheaper. Nuclear SMRs, small modular reactors, are coming online in the 2030s, or companies simply move the compute to regions with hydro like Quebec or Scandinavia. You are treating Bloom like a monopoly when it's really a stopgap. But let's bring this back to the stock price today. You are paying a premium for a future that has to execute perfectly.
I'm paying a premium for the only company that is actually delivering gigawatt-scale power to the sector that is driving the entire stock market. If you believe in AI, you have to believe in power. And if you believe in power, you can't buy the utility ETF and hope for the best. You buy Bloom.
Let's wrap this up because I think we are looking at the same data and seeing 2 different timelines. You see the next 2 years, I'm looking at the next 10.
Go ahead, summarize your bear case.
My position remains that while the technology is real and, I admit, superior to peers like Plug Power, the price is wrong. The stock is highly volatile, with a beta over 3. You do not chase a beta of 3 after a 500% run unless you like losing sleep. Investors should wait for a pullback to the 50-day moving average at 122.68 or the support zone at 131. The lack of insider buying is the loudest signal in the room. Management knows the valuation is stretched. If the people running the company aren't buying at 140, neither should you.
And I would argue that waiting for a perfect pullback to 122 might mean you miss the move to 200 or 290. We are in the early innings of the AI power crisis. The gap between power supply and demand will peak between 2026 and 2028. Bloom has achieved escape velocity. They have $2.02 billion in revenue, they are cash flow positive, and they have the blue chip partners. The Hilliard lawsuit and the OVBB paperwork are their speed bumps in a secular trend of decentralizing the power grid.
It's a secular trend, sure, but speed bumps can wreck a sports car if you're driving at 100 miles an hour. And Bloom is priced for maximum speed. One manufacturing defect, one missed quarter, and this stock fills the gap back down to double digits.
We both agree Bloom is no longer a speculative green play. It is a core piece of industrial AI infrastructure.
Agreed. It is an infrastructure play now. But infrastructure plays usually trade at 15 times earnings, not at these nosebleed valuations.
The disagreement is simply on the timing of entry and how much execution risk is priced in.
Exactly. I say wait for the dip, you say buy the breakout.
And the market will tell us who is right very soon.
It always does.
If you like this video and want to watch more content like this, then subscribe to the channel. Thanks for watching. See ya.